Great, so let's have a look at the financial indicator called net present value. So it's basically the current value of all future cash flows combined. So in other words, or to explain it in more detail, the sum of all the inflows and outflows of cash on a project over a period of time, discounted back to today's value. So NPV accounts for the time value of money. In other words, money in the future does not have the same value as money in the present. Money is discounted every year by a discount rate. So $100 today is not the same as $100 in 5 years' time. If you borrow $100 today from a bank, you will be paying interest each year, and the amount that you've paid back over 5 years is a lot more than just the 100 rand you borrowed. Also on the other hand, if you invested $100 in the bank and you got an interest rate over a number of years, over 5 years that interest rate or discount rate is going to increase your money, and it's going to be a lot more in 5 years time than today. So let's have a look at the example. So if we ask, how much money will I have 1 year from now if I invest $100 at 20% annual return? So we take 100 and we multiply it by 1.2, and that gives us 120. Good. Okay, so we take our we can do the same in reverse as well. We can ask, how much money do I need to invest today to have $120 1 year from now at 20% annual return? Then we just take $120, we divide it by 1.2, and we get 100. So this one is just from this side to that, and from that side, this one is from right to left. You can also see it that way. So it can also be done over multiple years. If we ask again, how much money will I have in 2 years from now if I invest $100 at 20% annual return? Then we take 100 times 1.2, and that gives us 120. And we take that amount again and we multiply it by 1.2, and that gives us $144. So just expressed more simply, $100 times 1.2 to the power of the number of years equals 144. And to put that in a formula, we say present value times 1 plus your annual return to the power of the number of years equals your future value. Good. So we can also do it over multiple years to calculate the present value. We ask, how much money do I need to invest today to have $144 2 years from now at 20% annual return? So we take our initial amount divided by 1.2, and that gives us 120. And then we take that amount again divided by 1.2, and that gives us our investment that needs to be done today. Okay, so we say future value divided by 1 plus your annual return, rate of return, to the power of the number of years, and that gives you your present value. So the reason why we calculate this is to account for the time value of money and to calculate if a project is really going to make a net profit or loss. Because if you don't account for it, it can look like a project will make you a profit, but if there's other investments where you could have made more money, then that would have been a better decision. Okay, so a positive net present value will result in a profit, and negative net present value obviously will result in a loss. Okay, so there's a handy Excel formula to calculate this. You just say equals NPV. You enter your discount rate, and then you enter all your cash flows one after the other. So this is a range that was included in this formula. Okay, so let's have a look at this practical example of a solar system. We've got a 50 kilowatt system. The cost is $38,705. The yearly income it's going to create for us in year one is 11,700. So okay, so there's a small mistake, that must be 11,650. So if we take this over the number of years, we see the cash flow of the energy generated less a maintenance cost will give us our cash flow each year. So we basically just take all these cash flows and enter that into our net present value formula at the specific discount rate. So let's take a discount rate of 5%. So each firm will have a different rate at which they are able to obtain capital from the bank. So we say NPV equals and in brackets your discount rate and then your cash flow of that range. So in this case it would be 5%, and that will be the first cash flow and the next cash flow and so forth. And if we enter all of that, it will give us a net present value of 274,000. So that was done over 25 years, and the end, the value of all those cash flows is 274,000. And that from our initial investment of 38,000, so it multiplied our money by about 7.